Hello, chart watchers, and welcome to this Monday, April 23rd Market Watchers live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time, welcome to the show. And for our regulars, welcome back. Well, the action is off to a pretty decent start today. Right now, we got the Dow Jones Industrial Average up 21 points, the S&P doing a little bit better on a percentage basis, up 8.5 points. The NASDAQ up 32 points, and the Russell 2000 up about 3.5 points. So all of our major indices are higher today, along with the 10-year Treasury yield. On Friday, we did see the yield break out to a new about 3.25-year high, hitting 2.95% on the close. That strength continues today with the yield up another 4 basis points, almost to 2.99%, now threatening that key psychological level at 3%. Volatility index, after being up earlier, has reversed today. You can see down about 5.5% today. The XLY, consumer discretionary, is leading the action. Clothing and accessories, which have been pretty much on a roll for quite a while, and 2018 has been strong for this group. We are trying to challenge and break out to a new high. This is leading consumer discretionary. Healthcare also having a pretty strong day today, about 0.5% higher. Medical supplies bouncing off, or trying to bounce off key moving average support and turning higher to lead to healthcare. The top performer in the S&P 500, Hanes Brands. Not exactly a great performer, but today it is doing much better, up roughly 6%. And I believe this is the top performer in the S&P. The S&P 500, by the way, I think 5 or 6 of the top 10 stocks were in this clothing and accessories area. And then Caterpillar, the second best performing stock in the Dow, trailing only Merck today. But Caterpillar upgraded, and the stock in a really nice flag. You can see the flagpole there, and just kind of sideways consolidating here. Caterpillar having a nice day today. And with that, let me bring in my co-host, Aaron. How was your weekend?
I had a very nice weekend. How was yours?
Mine is, well, it was good. The Caps are still alive, so got hopefully.
Oh, that's right. Hockey's still going on.
Yeah, for some of us, it's still going on. Yeah, it looked like we were going to be out, and now all of a sudden we've come back. And I don't know if this is like the biggest tease ever, right before we get eliminated, or if we're actually going to follow through and have another showdown with the Penguins. But right now we're up 3-2, playing in Columbus tonight. This could seal it for the Caps if they can win. If not, got to come back for a Game 7 at home, and we have not historically been a very good home team for Game 7s. So
yeah,
we'll see.
Well, we'll see. I mean, at least you're still in it.
Yeah. How's your weather out there? Did you have a nice weekend?
Oh my gosh, it's been so hot. We got up, and I think it was up to 90 on Saturday. It was very warm. I think we're going to be having 80s again this week. So spring has sprung.
It has. It still hasn't really sprung too much here in the southeast. We got rain and highs in the 50s today, so another chilly day. But anyway, eventually they're threatening us with spring weather.
All right.
Get it at some point. But anyhow, I'm gonna let you get into our announcements and the agenda, and we'll get going.
Absolutely. So this week we have lots on our schedule. Gaddis Rose is going to be our guest on Wednesday. Looking forward to that. On Friday, or Thursday, I'm sorry. We moved them to Thursday. On Thursday, I'm going to be doing my workshop, and I've decided I'm going to do it on moving averages. So I'll explain them and how you can use them. And then also we see on Friday, everything stock charts. So we should have someone in for that. I think we might have Grayson in for that, but I'm not totally sure yet. Should be a great week. As far as today, Monday setups will start us off after those technical headlines, followed by an earnings spotlight. John Hopkins is here. We haven't had him over for a while. And then we have 10 and 10 to 1. Our first symbol is going to be Nokia Corp, NOK. And finally, we'll finish it up. I'll give you the DecisionPoint report. And with that, let's just get this party started.
All right. Sounds good. Appreciate it. And let's take a look at that 10-year Treasury yield. Get a quick update. It has been moving, so even 5 minutes can make a difference. But it is still up there at about 2.99%. This was the breakout that we saw. This is just a 6-month chart on the TNX, which is the 10-year Treasury yield. You can see that February high, which was just below 295, we did close just above 2.95% on Friday, and we continue to move higher. We did have a negative divergence. We talked about that when it first happened, and we said there could be some sideways consolidation for a while. We got that. A little bit of movement to the downside, but clearly we are on a big move right now, big rally in Treasury yields. We were down close to 280 at this point last week. Now we're almost to 3%. That is a big move in about a week, maybe even just a little under a week. But we did have a couple of economic reports out this morning. April PMI composite flash came in at 54.8. The market was looking for 54.6. And then March existing home sales came in at 10 o'clock this morning. 5,600,000 units, and the market was only expecting 5,513,000 units. So a couple of pretty good reports, economic reports, and I think with the technical breakout that we saw on Friday, I think that combination is sending the Treasury yields higher. I'm a little surprised, I guess, that the financials are not leading today with this big breakout in the Treasury yield, but we did lead last week on the XLF at the end of the week. But you can see we still got overhead resistance here. I would think that we are going to play catch up with those yields and see the financials make a breakout, and I would expect the banks to do well as a result. The banks are moving back up above the 20-day moving average, and if we close there, it will only be the second time in about the last 6 weeks or so. Really hadn't been since back in the second week of March that we've seen any kind of sustained move through the 20-day moving average. So it is technically important to see this strength continue on the banks. Going back to that 10-year Treasury yield chart, I did want to point out the long-term view. So let me just pull that up for you. If we go in here and instead of the daily, let's take a look at the monthly. So I'm going to go back a long way, and I'm going to go 50 years back on the TNX. And what you're going to see is this long-term downtrend. And if I connect all of those peaks, and of course, trend lines are very subjective. I think just about everybody who's been on the show has talked about them. They're useful, but they are somewhat subjective. I mean, just moving them a fraction on the chart can make a big difference. But what I'm looking at here is roughly around 3.25% to 3.5% being that long-term trend line. Now, if I wanted to drag this and maybe connect monthly candle bodies instead of those tails, then maybe we'd be looking something about like this, which would then bring the number down closer to 3%. Now, I think that the most recent high, along with this trend line, is going to be pretty important because back in 2003, we had dropped substantially in the 10-year Treasury yield. I don't know if any of you are in the mortgage business. You remember all the refis that were taking place back in the early 2000s. That was with the 10-year low that hit 3% in 2003. We bounced back to 5%, and it was literally 6-7 years later before we started to move below that 3% level. And then, of course, artificially low interest rates followed, and we saw the double bottom come in not too far above 1%. I think it got down to about 1.2% or so before turning back up. But I think that this is a key reaction high in this long-term downtrend. So we've got the recent high, which was just above 3. When I say recent, I'm talking about 2014. And now here we are again at this level with a double bottom in place. So this would be pretty important breakout to the upside on the yield. Now, my feeling is there are a lot of folks out there who believe higher interest rates are going to hold back the stock market, and that's going to be a problem. I think it does present some headwinds for sure. But as money rotates out of bonds and the bond yield goes higher, that money tends to find its way into the stock market so long as the Treasury yields are going up because of economic strength or anticipated economic strength. If it's for some other reason, like to fight inflation, then we could have problems. That's not the kind of hike in interest rates that you want to see. But currently, we still have pretty low inflation, and the Fed's been talking about the strength in our economy. We're seeing it in a number of reports. So I'm not fearful at this point about Treasury yields moving higher. I think that there will be a level at some point where it's going to become a problem for the market. I don't think we're there yet. I would think maybe 4.5%, maybe 5%, where we have this double top. I think, that would probably really spook the market. But I think in the short term, we're still, and when I say short term, I'm looking at a multi-year chart here. So I'm talking about maybe over the next few years. I'm not expecting it to be a big problem. And I don't see yields shooting right up to 4 or 5%. I think we'll probably consolidate at this 3,305 area. I would think maybe pull back at some point and hit this rising 20-month moving average. That's all the way down at 221. I mean, we could consolidate from a longer term perspective, similar to what we did in 2017 when we fell back some, and we would still be in this uptrend. So there are a lot of different possibilities here. But again, I'm not going to be overly bearish just because Treasury yields are rising. If they're rising for the right reasons, we are moving up from historic lows, and money coming out of the bond market could help to fuel a nice rise in equities. I did want to mention, let's get out of here and take a look at the software stocks, because they were having a pretty decent day. And when you look at software, on a relative basis, software has been doing pretty well within the technology area. And the one way you can always check is just pull up your industry group and compare it to the overall sector. And then I like to use the line charts as opposed to candlestick charts. I just think it kind of cleans it up. It's not as noisy and messy. And what you're going to see here is that we have a very strong software space within technology. So if money rotates into technology and software is one of the leaders, then many of the software stocks should do pretty well. Now, I do want to caution you, though, if we look at the seasonality on the DJUSSW, and we go drag it back as far as we can go, 19 years, you can see actually May is not a particularly good month for software, but April is. So the strength that we're seeing right now does coincide with history. Now, another way that you can look at seasonality is to see how software has done relative to technology over the years. And when you do this, this is a chart I find very interesting. Look at May, only 6% of the time, which if you do the math, means that over the last 19 years, only one time in the last 19 years has software led technology in the month of May. Kind of an interesting stat. I'm not quite sure why that is, and love to hear from you if you think that you might know the answer. But it's almost a landslide for the bears, for the software bears, in the month of May, only one time. Now, some of the others I think look pretty good, though. If you compare, say, I think it's the semiconductors relative to the technology group, you can see that we actually do show some pretty good strength. In fact, 2/3 of the time in May, we see semiconductors outperform technology. So what we could be looking at, I don't think that software is going to be a problem in May, but we could see some money rotate. We haven't gotten the breakout in the software space, and perhaps we'll see a little bit of rotation. The other thing that I'll mention here is within the semiconductors, if you pull up Micron, which has been a pretty good performer. Now, recently, of course, it's run into some problems. But if you look back, look at May for Micron. 74% of the time, it outperforms the XLK, and it's averaged outperforming technology by 4.2% over the last 20 years in the month of May. So Micron is something certainly to keep an eye on. I wanted to mention in my blog article, historically, this week that we're in is not a great week for NASDAQ stocks. Actually, it's not a great week for S&P either. But here's the breakdown. This week, April 23rd to the 27th, it's been down about 7%. That's been the annualized return since 1971 for this week. But we go beyond that, and then we get into the tail end of April and into the first week of May, and you can see historically that changes. And we do see a lot of bullishness as we close out April and head into May. So maybe if we can get through this week of earnings without too much technical damage, maybe history will kick in and we'll start to see some additional strength as we head into May. Also, I wanted to mention last week's poll, if you remember, we had 5 stocks in 5 different sectors, and we took a poll and said, which one of these charts looks most bullish? We had AXP, American Express, in the finance group, Schlumberger, SLB, in energy. IBM was the stock we chose in technology, General Electric, GE, in the industrials, and Johnson & Johnson, J&J, in healthcare. They were all going to be reporting last week, so we had to poll which one of these charts looks most bullish. Well, and this doesn't answer the question definitively, but after 1 week, the results that are in, General Electric actually last week is up almost 10%. believe it or not. Huge move in General Electric. So I would say that those who, and I think GE might have been on the bottom of everyone that had voted. But GE was the winner. American Express also did extremely well last week. AXP, I think that was Aaron's choice, and a bunch of you as well. I think AXP may have been in the second position behind Schlumberger. And Schlumberger, of course, being in energy, I can understand why folks would be interested in that stock last week, but it actually was flat for the week, finished in the third spot. I do have to mention that my pick, IBM, was dead last. So if you followed me, you followed me right off the cliff, because IBM, and that's, by the way, that is why I don't like to hold stocks into earnings, because even technically I saw some improvement in IBM, but you go into earnings and literally anything goes. And IBM was hit the hardest among those 5 stocks. So congratulations to those of you that went with GE. Big week last week for the general.
Yeah, amazing.
And with that, I'm going to turn it over to Aaron, who's got some upgrades and downgrades for you.
All righty. Let's get that screen shared. We're going to look at 2 upgrades and 3 downgrades today. These are the 3 downgrades, and as you can see, the 2 upgrades. I thought it really interesting that we talked a lot about Caterpillar when Julius was here. I think it was on Thursday, and sure enough, now we actually ended up with this upgrade. So I thought that was interesting. I'm going to start with the upgrades. Let's start with Caterpillar. And I went ahead and annotated a few of these. Let's make it bigger. There we are. All right, so what the first thing I noticed when I looked at this, actually, and I didn't annotate it because it makes it very messy, but there's a big flag here on Caterpillar. So it was already poised, back in the middle of April when we got the PMO buy signal and oversold territory. And now we saw the move off of that. We're taking a pause, and that's what's forming the flag on the pole. I would be expecting a breakout, and you can see there's a lot of upside potential here. And I think you could set your stop fairly tight by, laying it down here at 150, and you've got a move that hopefully you'll get out of it to at least 170. But I'm thinking Caterpillar still looks very good as an upgrade. It doesn't look stretched out at all. Now we're looking at Michael Kors Holdings, the other upgrade, and we can see the gap up today on that upgrade likely. Look at the PMO, it's starting to accelerate higher. It also came out of overbought or oversold territory and is moving higher. Like that breakout, at this point, we're going to be looking for a breakout above the January top here. I'm not as concerned about this particular one because we didn't close. We closed way down here. But I'd like to see this breakout, and it sure is poised to do that. Of course, we have a over 4% move today, so we might want to wait for that to pull back just a little bit, but I would be looking for a breakout here. Downgrades, Lululemon. It's in, it got the downgrade, and a lot of times, like I said, we can look there for possible bottom feeding or bottom fishing, however you want to think of it. But we have this short-term rising trend, and it has not been broken even on the downgrade. The PMO is still rising, and one of the things I liked about it is that even though acceleration was fairly consistent, the PMO continued to rise, and a lot of times you'll see it flatten out when we start getting a consistent acceleration going on, and we're not getting that. So I like the way this is looking, and check out that OBV. So even though this was a downgrade, we haven't seen this rising trend channel broken just yet. Pier 1 imports. This one is this is bad, bad, bad. The daily chart looks bad. I went in and took a look at let's see, where is the weekly chart? There we go. Hey, remember sunset? There it is. All right, so on the weekly chart, you can see we had that terrible drop, and then we broke down. That's what we saw on the daily chart, was this breakdown from this area of support. Where's support now? Well, let's go to the monthly chart and take a look, because that's what I was thinking. All right, well, where is it? This is really bad. The $3 range here, let's see. That's where we had some support back here in 2007-8. And now we're looking at that being broken, and I don't see support under that. I mean, it just looks like it's going to fall down the cliff. So I would avoid Pier 1. They must have some stuff going on in their company right now.
What was interesting on that one, Aaron, is I was looking at it on my relative chart, and of course, from August through January of 2018, the home improvements area relative to the S&P 500 did very well, and Pier 1, which is in that home improvement index, was an awful performer relative to the S&P, and obviously it was weak relative to its peers. And these are the kinds of stocks when they're not performing as well as their group. You shouldn't be shocked when you see price action like we're seeing today in the downgrades and so forth. I mean, this is as you said, very weak stock, and it's not one that I would be interested in at this point.
No, and I don't even see it as one to watch,
No.
for a place to get in. There's no support. So, and finally, SunPower, really quickly. Let's look at that. Big gap down today. We hit this area of overhead resistance that I marked off back here. You could even consider this area, these tops, part of that overhead resistance. Popped up, immediately failed, and have been coming back down. However, I like that you've got these rising OBV. Look at this. We're still seeing the scooters, still rather healthy. Nice move on the PMO. It's still trending higher. And now we're at this very interesting area of support. And you can see it stopped right now on gap support from when we saw that gap up. I would be looking for it to close that gap and find some support here at about 840. And that's where I'd be looking. That's where I would probably put it on the watch list and set a price alert, because I think this one has some opportunity to move up off of this very strong area of support, when you match it up with these bottoms and tops. And that concludes the upgrades and downgrades. I'm going to take us over, and it's time to start the Monday setups.
Yep, you got me this week for sure.
I did, huh?
Yeah.
Let's take a peek at what we got going here.
Yeah, I'd rather not. Let's just move on.
Well, it wasn't a great week for me either. DXC, the last I looked at it, it was at 103.86. So it looks like it eked out a little bit of a gain there. And TPH, the last reading I got was 1627. So yeah, that was it looked really good. I thought you picked pretty well there. Just that really bad move. And I'll go ahead and pull those up.
The biggest thing with TPH and really all of the home builders was the huge spike in the 10-year Treasury yield. I mean, that's gonna dampen enthusiasm for home building stocks, even if it, in the long term, maybe doesn't make that big a difference. Short term shock value, you're definitely going to be a seller of home builders when rates are moving up as fast as they did. Like I said earlier, almost 20 basis points on the 10-year Treasury yield last week. So that I still like the group, and I really like TPH on a relative basis, and I think it's consolidating in a nice triangle. But right now it's not performing.
Yeah, we're hitting support though here at that 200, and the PMO is trending up. Yeah, we've got a sell signal today, but that it's hard when you get a drop like that. That was Thursday, so. But I can see why you picked it. I mean, like I said, it looked pretty good to me. The PMO was rising. You had the 20 getting ready to cross the 50, so not bad. And then mine, let's see, I have that in here. And there is mine. So my stop was at about $100, so we never even got close to that. So, if you're holding this, I'd continue to hold it. It's holding that support level. And I'm still looking for a breakout. You've still got the OBV rising. Scooter's still very healthy. PMO on a buy signal out of oversold territory. It looks good to me still. It just didn't do that much. All right, so let's view all here so I can show you what I did this week. I had quite a few actually that came up. I actually ran one scan, and I only got about 5, and then I ran the other scan that looks at more than just the S&P, and I got a bunch of others that I thought looked really good. And I find it interesting. I overheard that John Hopkins is going to be covering Square. And I had already made it my pick before I heard him talking about it. I just had to chuckle because I think if you guys look at that chart, I'm interested to see what he has to say. So anyway, these were my 5 here that I did not pick. My pick is going to be Square. I'll go through these just really quickly, and then I'll show you Square and why I decided I wanted it. So we have a lot of possible bull flags. I noticed on a lot of these charts. This is a declining tops trend line, and it actually is holding as a support area. And we've got the flag. I like to see those flags angling down, and the PMO is about ready to give us a buy signal. So I thought this chart looked pretty good. Globus Medical was the other one. It almost was my pick, which is why I have all this little information here. But I changed my mind. The PMO started to kind of look not as good. It started to trade at intraday lows after failing to really pop above that overhead resistance. I think that on this pullback, though, it gives you some opportunity, certainly. On this one, I would probably add it to the watch list. I mean, OBV looks good. The PMO just doesn't want to move. And I know that's because we got that big intraday drop. Which makes me happy in a way that I didn't pick it as mine, but in a way not so happy because I think there's more upside potential now on GMed. Mind Body was the other one. And again, flag formation, it's holding the support level at that April high here back beginning of April. PMO, it was looking better when I had my scan again this morning. It was an intraday scan, so you get some interesting results. But I still think this one looks pretty good as long as it holds that $40 support area, and it's poised, to move up to that 42.50 area after that, or 44. So I still think this one looks good. Activity Health. This one is I kept it. It's in a trading range, and we're kind of near the bottom of that range. This is, it doesn't do much, admittedly, but it's at least near the bottom of that trading range, and it is set up to do well. Usually the buy signals come in and are pretty accurate, but we're failing to get that, and now I see that PMO curling, so I could probably take that one off the list today. In fact, Mr. Producer, you don't have to add that one to the list. I don't want that out there as a Monday setup now. It doesn't look very good. This one is also it's starting to look not as good. We do have that PMO topping below the signal line, but we do have a really nice flag formation here, and that declining tops trend line is holding. I'd like to see that breakout, but a 1% drop today on a possible Monday setup gives you some opportunity there. So I still think that one is worth watching. But Square was what I picked. And I just love this PMO buy signal right on its way. The buy signals and sell signals on the PMO have been very clear and not noisy, and they've been very good at picking tops and bottoms in the shorter term. So seeing this oversold in positive territory, no less, PMO buy signal lining up on Square, which we already know is a very strong stock in its space. And look at the upside potential here, quite a bit. So when I did this earlier, it was at 51.48. Now it's at 50.96. So I will take that since everybody else is now seeing it and they would be potentially able to get in at that price. So I would say 50.96. My stop I have at 49.50, and you can see why. That's about where the 20 is. But I think you could even, with a stock like this, I think you could even move that stop down to that $49 range if you'd like to. But I'm a little bit more cautious on my very short-term trades. Target is over 57.50. I think I'm looking for a breakout on this one. So Square was my pick at $50.96.
Awesome. All right. So got you in the books. Let me go ahead and bring up a couple stocks. I'm going to go ahead and start with Nike, which is my pick. I put this one in my blog this morning, so I'm going to go ahead and go with it. even though it is up a little bit today. I'll go with the current price, which is 66.60. I'm marking that down.
Mm-hmm.
66.60. I like Nike. I think it's while the market's still in this consolidation mode, I think it does provide a little bit of protection just because it's such a big company. It made a big entrance into April to start the month, big move up, got close to breaking out, didn't quite make it. And over the last 2 or 3 weeks, it's pulled back. And I think that's presenting an opportunity. I think we have equal highs coming across. And I also think we have higher lows. So I think we've got a nice ascending triangle pattern in play on Nike. And when I look at the relative chart, I think Nike is obviously a pretty good performer. It's had a huge run up from October through January and even into latter part of February. And that was after a lot of the negativity hit the market, where we saw that selling in the high spike in the VIX back in early February, first couple of weeks. That's where you can see this pullback, but we went back up and put in a new high. So definitely is showing some nice relative strength. I think also the footwear index in general looks very similar to Nike. Of course, Nike is a big part of the index. But I like this recent spike and breaking out Nike relative to the footwear index. Part of this is Skechers absolutely getting killed at the end of last week, and then into today, I think it was down again. But relative to the S&P, Nike has been a pretty good performer, and each time it's pulled back on a relative basis, it's presented a nice opportunity against the S&P. So I think that Nike's in a pretty good position here. And overall, the footwear index has also been doing the same thing. It's been rallying against the S&P, pulls back, for a few weeks, little consolidation, profit taking, but it continues on a relative basis to print new highs and new lows. So I really like Nike. I think that this is maybe a little bit more conservative than some of the picks that I normally would go with. But again, given the market, the state of the market and where we are right now, probably not a bad choice. A couple of other stocks that I'll mention before we wrap this up. Let's take a look at SGH, which I think I was watching this one today. I'd really like to see a nice reversal on the 50-day moving average. But you can see the breakout on increasing volume in the middle of March here, above about that 41 level. We had a prior high here of 42 and maybe 43 and change. So I think this 41, 40 to 42, 43 area, I think, is pretty important on SGH. And this was a stock that was at 56 a little less than a month ago, and it's come all the way back down to the low 40s on lesser volume for the most part. We did have this one gap down, but I think we could see a reversal here on SGH. So I found that one to be interesting. TWOU also selling off here the last few days, getting close to an area around 82.50 where we've been holding in the short term. It's another stock. It was trying to make a breakout here, printed a bearish engulfing candle with a negative divergence in play. And I think that's what led to the 50-day moving average and that PPO centerline test. But I would look for some strength maybe off of the 50-day. I think 82.50 down to 77.50 is a nice accumulation zone on TWOU and keeping a fairly tight stop underneath of it. So those are just a few of the stocks that I liked. And the SGH and TWOU both came in off of my strong earnings chart list, as did Nike. But SGH and TWO both had RSIs in the 40 to 50 range. And I think Nike also, pull that one back up. The RSI is at 50 now, but I think it was at 47 as of the close on Friday. So that's what I like to look for. I like to get these stocks on pullbacks and try to increase my reward to risk on the trade. So I'll go with Nike. You went with Square, and here is a recap of the stocks that we just talked about.
Indeed. Yeah, we'll have to see how it goes. I'm ready for a big winner.
Yeah, this market's kind of frustrating, but I think that's typical. Each week, we have a good one, then we have a bad one, and I think that's kind of says a lot about the kind of market we've had really the past 2 to 2.5 months. It's just been a very volatile, rocky, back and forth, a lot of rotation, not a whole lot of leadership, at least not sustained leadership. And that's made it a little bit more difficult to trade for sure. And I always talk about high volatility. Anytime you get the volatility index moving up above, say, 15, 16 level, I think that makes for very difficult trading personally.
Absolutely. Hey, we have a quick question for you in the chat box. It says, can Tom opine on why small caps are continuing down when the dollar is heading up? I love it. Go ahead and opine for us.
I'm going to opine. I'm just going to say that, first of all, it's not a direct positive correlation. It is something that just makes sense to me over time, that if you have a rising dollar, it's going to eat into some of the profits of the multinational companies like those found on the S&P 500. And the S&P, when we had the dollar struggling in 2017, of course, the S&P 500 led on a relative basis. But I think if you look at the Russell 2000, and I'll just pull up one chart before we bring in Mr. Hopkins. But if we pull up this relative chart on the Russell 2000, and then let me switch it over to a line chart and go back a year and 6 months, that'll take us back through the beginning of 2017. During this whole year, I mean, this is about when the dollar topped in early December of 2016, and it went down throughout 2017 and into 2018. And you can see the Russell 2000 lagged. Well, I think that the dollar is starting to rise. And while we might be seeing a little bit of short-term weakness in the Russell 2000, I think you can see that since the end of February, the Russell 2000 has been outperforming the S&P 500 pretty solidly. And if the dollar continues to move higher, if it makes that breakout, and I didn't even look at the dollar, but one last chart, let's just pull it up.
Yeah,
Hey, Tom, nobody's seeing your chart there.
Oh, I always do that. I'm so sorry. Yeah, once it switched.
I'm sorry I didn't catch it earlier.
That's okay. Let me go back and show you that last chart, though, because I think that was kind of important. This was the Russell 2000 relative to the S&P 500 from December of 2016. This is about when the dollar topped, and then the dollar was weak for about 14 or 15, 16 months. And you can see that the small cap struggled against the S&P. That means the S&P was doing much better. And that makes sense in a weak dollar environment because the S&P will get a lift in earnings when they translate profits overseas into a cheaper dollar. But now what we've got is the possibility, and we're actually getting it, which I just saw. I think this is what Aaron and I have been talking about for quite a while, and something I've been looking for, a breakout to the upside in the dollar. And I think that favors small cap companies. And you can see over the last 7 weeks or so that we're getting a lot of outperformance by the small caps. And so with a breakout in the dollar, and I thought it was just a matter of time with the 10-year Treasury yield here in the U.S. strengthening against the yields elsewhere, especially in Germany, that normally leads to a rising dollar. I think this breakout is very significant. I think it's the start of something much bigger to the upside. And so I would really favor small caps throughout the summer. We'll see.
Yeah, I'm finally applauding. We finally got a breakout in the dollar. I've been waiting for this.
It's really putting a damper on the gold. We saw that false breakout a couple weeks ago, and now for the last 3 or 4 days, you can see gold really taking it on the chin. So as the dollar breaks out, I think this is bad for gold and the miners.
Oh, heck yeah. I'm going to be talking about that a bit at the end of the show. So,
yep. All right, well, let's move on because I know we got Mr. Hopkins waiting patiently. This earnings spotlight is brought to you by earningsbeats.com. Earningsbeats.com provides high reward to low risk trades. This strategy resulted in a 2017 risk-adjusted return that outperformed the benchmark S&P 500 fivefold. Earningsbeats.com only trades companies that have beaten Wall Street estimates as to quarterly revenues and earnings, and they'll teach you to focus on that combination of strong fundamentals and strong technicals. Learn to exercise the patience and discipline of an experienced trading service. Earningsbeats.com, better timing, better trades. Welcome to the show, Mr. Hopkins. Did you have a good weekend?
Hey, not too bad. How about yourself?
I did not have a bad weekend at all.
Yeah.
We're both Caps fans, even though we're now down in South Carolina, so they're still hanging. That's a good thing.
Absolutely. Even the Wizards came back. That series tied 2-2.
Well, that's yeah. I mean, Toronto, not the Maple Leafs. I don't want to bring up the Maple Leafs. That's a whole different story. But the Toronto Raptors have struggled in the playoffs, and so it's only fitting that the Wizards, who have always struggled in the playoffs, play somebody else who struggles in the playoffs, and may the best team win.
Yeah, and I know we have a lot of Canadian listeners as well, so I'm not going to say anything that might offend them.
Well, we try to take care of our Canadian friends.
I love our Canadian friends, believe me.
Yes, absolutely.
Hey, I've been listening to you too.
Yeah.
And actually, a couple of stocks that I want to go over in a minute are ones that you talked about, but that's okay. This is one of those periods. This is one of those periods where I think you have to make a decision. Either you just step aside because volatility's been, quite high recently, or you have to really focus on those stocks that should hold up the best no matter the environment, but also be prepared to take some losses, because it's one of those, we've been doing this a long time, and it's one of these markets where there's not a lot of forgiveness. And, you can make some really nice gains quickly, but you can also see a stock fall out of favor quickly as well. And this is why at earnings beats time, we focus on stocks that beat expectations and top and bottom line, wait patiently for them to come back to us. But if something goes against us, we're going to get out. And it's one of the reasons, that we've been able to consistently keep a high risk-adjusted return relative to the market. And I know you're going to talk about that in just a minute in terms of performance, but I thought, you want me to go over a couple of stocks first, or what do you want to do?
I want to go through these numbers because this is
okay. Let's do that.
Yeah, this is very impressive. And for those of you who don't know, I used to work with John at Earnings Beats a few years back. I left in March of 2015 to come on board the stock charts, and John handles everything now over at Earnings Beats. But my background being a CPA, I do go through and calculate the risk-adjusted returns, and I did that over the weekend on a quarterly basis. Last year we had done it like on a year-to-date kind of a basis,
Mhm.
and I broke it down. And I just want to point out, number one, first of all, these numbers are fantastic, and I'm going to go over them a lot more. John's doing a webinar later today. I wasn't planning on being it, but after doing this, I'm going to actually go into the webinar and spend about 15, 20 minutes and go through some of the details of this calculation. But I find it very impressive, and not just earnings beats. I'm just talking about in general, being patient and being disciplined about keeping your stops in play. Now, what I've done here is down on the left side, and I'm going to go over this very quickly because I know you got stocks to go over. But each quarter I've broken down. We started doing the calculation as of the second quarter of 2017. So now we're into the 5th month of doing this calculation. And throughout the period, I think, John, you've never had more than 7 stocks out. So I
Right.
always do the calculation, just assuming it's all theoretical.
Mhm.
But you have at Earnings Beats all of the trades and everything documented. But in theory, if you assume $10,000 per trade and you never have more than 7 stocks out, you can have a portfolio of 70,000 and never have to go into margin interest. That's the reason why the 70,000's here. Then I've got the S&P 500, the actual return of the S&P 500 by quarter. And then, so if you actually were holding and you just bought the SPY and just let it sit there, this would have been your return each quarter on the S&P 500. Now, this is going to get into a kind of a little bit more of a complex calculation, but essentially what this is how much money was invested. So for instance, if you're in the S&P, you got to put your entire 70,000 in there to compare how you're doing on a risk-adjusted basis versus the benchmark S&P 500. But if you've only got one trade out at a time, then for that particular day, you've only got 10,000 invested in the market. So what this average amount invested is exactly that. It's how much of the portfolio is on average invested in these various trades that Earnings Beats have put out. There you can see the averages. This is actual returns based on the $10,000 investment and how the trades did. And you can see in 2017, it was about double the actual return. But what's really interesting is look at the amount that was invested. And so your risk-adjusted return is based on your actual return divided by how much you're actually risking, not your portfolio balance of 70,000. But if you're only investing 15,000 and you can generate a return that is similar to what the S&P 500's return, and you've invested 1/5 the amount of money, that's pretty strong performance. And the last thing I wanted to mention is if you look at the winning and losing trades, and I think this is really important because for me, I know when I first started trading, I didn't like to accept losses. I hated taking losses because to me, you're admitting that it was a failed trade. And so you're always waiting for that stock to come back. And then the problem is that a lot of them don't come back and you just end up taking a much bigger loss. So when I looked through this, John, I saw, first of all, since the Q2 2017 began, if you add across or down here, you've now had 47 winners and you've had 53 losers. So 53% of your trades have gone against you. And I'm not saying that's a bad thing because if you're going to be disciplined, you're going to get stopped out. Sometimes your stocks are going to bounce back or whatever, and sometimes they're not. But if you look at the average gain per winning trade and the average loss per losing trade, and then compare the two, this gives you the reward to risk. And you can see that these numbers, you don't have to hit 80%. You don't even have to hit 50%, as these numbers show. If you are able to, be patient and then exercise discipline in your trading. So I thought that were awesome. I'm going to talk more about the individual trades and so forth later in the webinar, but I just wanted to mention this because I think it's fantastic.
Yeah, and again, I think what it all boils down to is, as you pointed out here, is you minimize your losses. I think if you went back, I'd have to look at every trade, but I think if we went back a year on all the trades that we're involved in, my recollection is I don't know if we had a trade that lost more than 5%.
Maybe one.
Maybe one.
Yeah.
Okay. So the whole idea is, and I'll show you later in the webinar tonight, I'm going to show a couple of examples of stocks where we had very tight stops where we maybe lost 1 or 2%, and a few of them continued down 15, 20%. And if you allow that to happen, you have 4 or 5 trades like that, you're not going to be trading, very long. So I'll do some of that tonight. And I know we're tight on time here. So I'm really not going to get into to too many stocks here. You actually went over a couple of stocks. One was Square that you had talked about. And that's a stock that we had issued. Here's what I mean by high reward to risk. This stock, we got involved in April 6th at 45.15 because I liked the way that it pulled back nicely. We had a stop of any close below 45, and we had a price target of 49.50. So you basically had about a 25-to-1 reward to risk. If it went against us, you'd lose a little bit, but it went in our favor, became a 10% winner. And that's when I talk reward to risk. That's what I'm talking about is like minimally, 2 or 3 to 1. But if you can get something, 10, 15, 20, it's good risk. And another stock was Snap. And we had talked about this one, stocks that might run into their earnings reports.
Yep.
And you can see what it did back when it reported. It just, gapped up massively and it pulled back. And we got involved in this stock on April 10th at $14.28. Our price target was $15.70. We took it off the table today. It got right up, close to $15.60. So we got within 1% of our target. This is what I mean about you got to take your profits when they come along in this kind of market. So that turned into an 8.8% winner, and it was a 4-to-1 reward to risk that worked out. And then let me just pull up a couple that didn't work. One was GPS, Gap. And, this is one that we got involved in with the entry price. This was last on April 19th. Entry price $29.36 with a stop of any intraday close below 29.
Intraday move or a close?
Excuse me, intraday move below. Okay. And it fell below the 29, so we got out, loss of 1.2%. It continued to pull back, quite a bit. It's trying to hang in there today. Maybe this will be a day it reverses. But if you held on to it, it kept moving lower. And then the final one I'll talk about is Len, L-E-N, Lennar.
Yep.
Got involved in that one on April 12th. Entry price of $56.58, price target of 61. And on this one, any intraday move below 55.45, it happened, lost 1.9%. The stop, that did keep moving lower. But the whole point is, if you look at all of these, just these 4 or 5 stocks I've talked about, a 10% winner, an 8.8% winner, and a couple losers of 1 to 2%.
Yep.
And it's that whole risk-adjusted thing, that if you're going to be involved in the market here, you got to keep, tight stops. And if you get the profits time, you have to take them.
Yeah, and I've looked at some of your setups and, some of the stocks you've talked about, and I don't always agree with, where you see your support or your resistance. I mean, everyone's different and looks at a chart differently. But I think it is important, regardless of where you see the support, you do have to maintain your discipline on these stocks as a trader, because your capital is your business. And if you start letting the capital erode, especially if you start allowing that the emotions to creep in, you think, okay, well, on Lennar, if it goes down, it's a little bit further. You're thinking, okay, I'm still only down 3%. That's not bad.
Right.
Well, a couple more days, and then all of a sudden you're down 5 or 6%. And then, next thing you know, you're down 10%. And now you're looking at a weekly chart. And you say, well, now I've got more support. And it just keeps building and building. And so I do like the fact that you're very disciplined with your stops. Again, they're not always where I would set my stop, but I think it is important to maintain that ratio on your reward to risk. And I think that showed in those results I was showing, where if you're going to make money, make your 6, 8, 10% or whatever. And if you're constantly taking 1 to 2, 2.5% losers, you can do the math. You don't have to hit 80% of your stocks to make money. You can actually do it hitting less than 50%, which is what I think was demonstrated there.
Exactly. Okay, so anyways, tonight you got a free event. You can just go to earningsbeats.com and you'll see there's a special up there. It's a free, sign up, right? It's a free 3-week, free 3-week trial. You can sign up. Doesn't cost you anything. And what I'll do tonight, you're going to come and talk a little bit more in depth about the performance, the risk-adjusted concept. I'm going to talk about some stocks that we had out, some winners and losers. Then I'm going to talk about some stocks that recently reported, Tom, beat earnings expectations and do some setups. So in other words, go over a half a dozen stocks or so with people on stocks that reported recently. They made nice moves. Now let's talk about entry and exit and target levels. And then we've got some stocks coming up this week reporting earnings that I'm going to talk about. And of course, Google's reporting after the bell. So we'll see what those results are. And we're going to see if the market's ready, to stabilize here and if we get a series of companies that beat nicely, does the market turn around here, or is it just up against too much other stuff right now?
Yeah, I do want to just clarify one more thing for anybody who does come in. How do they get into the webinar?
I'm sorry?
How do folks, if they sign up, how do they get into the webinar?
Well, I'll send them they'll be getting an email prior to the event with instructions.
Okay.
Yeah, it's simple.
Okay, awesome.
All right, thanks so much.
Yep, thanks for stopping by, and we'll see you again probably in a couple of weeks.
All right, bye-bye.
Great, thanks, John. There he goes. And so there is your earnings spotlight, some of the stocks that we just covered. And I tell you, the results were amazing. And I'm not really trying to show earnings beats too much love. It's really the concept of managing your trades. Everybody manages them differently. Everybody uses different stops. And I don't care if you're an intraday, literally a day trader, or whether you're a short-term swing trader, or whether you like to position trade and hold trades for a little bit longer, you still have to have that discipline of, if you're somebody who's going to hold for an extended period of time and maybe make 20, 30% on a stock, then you don't need a 1 or 2% stop. I think that's probably a little bit too tight. But everybody's got their own style, and you really need to incorporate managing risk into it. And there you have it. So I guess we are ready to move on to the 10 in 10, Erin.
Yes, indeed. Let me go ahead and get that ready. I have already added all of the various symbols that have been requested. I decided to put them all in a correlation table. It's very easy. You just view the list as however you want it. Usually we do RRG, but I thought correlation would be interesting. And as you can see, not a surprise, a lot of the stock symbols are highly correlated to the S&P. When you start going further down the list, of course, these are not correlated as much to the S&P. And then we actually have 2 on the bottom that right now, over the last, I think it's 20 trading days, that these 2 have not been very correlated to the market at all. And one of the ways to really help diversify your portfolio, one of the ways to do that is to look at correlation, so that you can have some on both sides. You want to go with the market, obviously, when it's bullish, but you still want to have some hedges. And this is a way you can find hedges, is by looking at which ones don't follow the market so closely. And with that, I'm going to pass it back to you. And our first one is Nokia, NOK. And get your likes in, because the next symbol is going to be whatever the most popular one is in the chat room because of likes.
All right, well, here we go with Nokia and OK. This kind of goes back a little bit to what I was talking about in my workshop on Friday between trading breakouts versus consolidation. And so we have major gap resistance right here. You can see the huge volume gap down from October of 2017. And we gapped down from about 605. I don't know what the exact number is, but pretty close. Went all the way down in the fours. We've worked our way up, and today's open was at 593. Well, it says 593, but actually it looks like on this candle, it might be a little above 6. But anyway, the point is that we are going up and we've tested. We've now filled this gap. And so for me, the chart looks pretty good. I like you can see the blue arrows, some heavy volume coming in on the move to the upside, but we had a failed breakout. So now for me, it's more of trading a consolidating stock, or, a stock that is in consolidation mode. And I've got to look to see, okay, at what point would I get out of this stock? And there are a couple levels that I think you have to watch. I think that it could be the bottom of this gap support, the top of the gap support, or the rising 20-day moving average. You got to figure out which one of those is the most important, and that's where I would have my stop in play. And then set up buys on a pullback. I would be more interested in either a pullback, maybe to gap support here. It looks like maybe 577 or so is a major support level. The rising 20-day moving average is at 568. So those would be two levels I would consider. And then a close below 560, the bottom of gap support, would probably be my stop. And I would just be looking on this for maybe a move back up to about 605. So that would be my strategy in this trading range. But if we break out, I'd be looking for heavy volume to come back in, and then maybe buy the stock on a move through 610. And then I'd keep a fairly tight stop around $6. If the stock gets up 5-6%, gets up near the prior double top, I'd be taking profits, because that's a little bit longer term consolidation.
All right. Let's see, the most popular in the chat room is Twitter. And that was followed closely by Micron, but I think you talked about that one already.
Yeah, I talked about Micron earlier. I think Micron, I did it more on a seasonal basis. But let's see here. Let me get this. All right, so there's your target. If Twitter gets up to 36.5, 37, I would be taking profits for sure. I do like the fact that we got back through some resistance and that we are now above the 20-day moving average. So I really want to watch that 20-day moving average. The price that I was talking about is right here. So you can see after gapping up, we pulled back, we held on around $30, moved higher, broke down below 30 on heavy volume, came back up, struggled at 30, and then on big volume broke above 30 again. So I think that rising 20-day moving average along with 30 is your two key support levels.
All righty. Let's see, the next one I have for you is the social media index ETF, SOCL.
All right, got to get through the 20-day moving average. I mean, this looks a lot like some of the internet indices. I think internet did break out above the 20 last week, but you can see here that we are struggling, trying to get back through that 20-day moving average. Multiple tests here, and so far failure. I would be looking. There's also some price resistance at this area as well, as you can see on the selling right here. This was a reaction high at about 34.60 or so, and that's right where we're turning as well. I think a close back above, say, 34.75 would be bullish in my view. Until that happens, I would maybe be looking for pullbacks closer to support between $32.50 and $33.
Okay, let's look at Textron, TXT.
I think this is the one I mentioned last week that had great earnings and a huge move up. Yeah, I love this chart. Now, the way that it's traded with all this volume and the gap up, the low close after the earnings was 64. I think if we get back to 64, I'd probably be a buyer at that level. And if you wanted to lessen the risk a little bit, then consider maybe the rising 20-day as a second entry. So in other words, first entry at 64. If it does continue moving lower, maybe your second entry would be the 20-day moving average. And then I would use the bottom of gap support as my closing stop. So I think that weakness in TXT would be a good time to begin accumulating. I love the high volume gap up and their strong results that they came in with.
All right. Key Corp, financial, KEY, Key.
All right. Yeah, I would expect that this stock would be doing better. This is the, I think this is the bank, right? If I'm not mistaken. Yeah, it's in the bank index. All right, I'll just go ahead and pull this up. Yeah, I mean, here you can see Key doing very well until the middle of March. And you can see that's when the bank index struggled, went down to fresh lows, as did Key. And if you're looking at Key relative to the banks, I'd probably be looking for a different bank. I mean, we had a couple of periods where we saw some relative strength, but for the most part, if you look back over the last several months, this is a company or a bank that's been struggling relative to its peers for the most part. It's also been struggling relative to the S&P. I think you can find some other banks that look better. And where I would be interested or become more interested in this particular bank if we could get through $20. I mean, I think it's pretty clear that was a major support level going back over the, earlier in 2018. We lost that level on some pretty good volume, and that is where we're struggling to get back through. So a break above 20 with some increasing volume, I'd start to get a little bit more excited. But to be honest, I think you could probably find other banks that look better.
Okay. Let's see. How about Grubhub? Grub.
And I know this one's on my strong earnings chart list, and it's been a monster throughout the many, many months going back. I'll do this on a relative basis as well, because here's your restaurants and bars index, which has just been kind of floundering. But notice while it's been floundering, Grub has been continually moving higher. And so clearly when you get into the relative strength, you're going to see that Grub has been a great performer, even though restaurants overall for the past several months have not been. So for me, again, this is, if I'm annotating this, I'm going to be looking at this downtrend. So I'm not a huge restaurant fan, although it is in consumer discretionary, which is doing pretty well. But what I do like about the stock is that it has been a strong performer here relative to the S&P 500, and then also relative to its peers. So you've got a strong stock. If restaurants start moving to the upside, you're probably going to be able to significantly outperform the S&P with Grub, as long as it stays technically sound like it is now.
All right. Let's see, the next one is the only consumer staples requested stock, Kimberly-Clark, KMB.
Yeah, KMB, they reported this morning, and they matched expectations on the bottom line. I'm actually looking through my notes here. Yeah, they beat on the top line, 4.73 billion versus 4.60. They matched estimates though, and it just wasn't enough. This is a group, the consumer staples, that are completely out of favor, and the stock's, earnings on the bottom line were just so matching estimates, and you can see the big volume breakdown here. So this is a stock personally that I would avoid.
All righty. Next one is for our Canadian friends. Let's see, KEL.TO, and that is Kelt Exploration, an oil and gas producer.
Right. Yeah, I mean, we just got a reversing candle right at resistance. So that's a little bit of that was a short-term warning. And going back to my workshop that I did on when to sell, I gave a lot of different reasons when you might sell. One of them is hitting resistance, false breakouts. You can see short-term, from a short-term trading perspective, that's important. If you get out at 8.10 and 2 or 3 days later, you could get back in at a 5% discount, that makes a big difference. Now, for me, I actually would like this more on a test of that rising 20-day moving average because the PPO is strong. So pullback testing the rising 20-day is where I would be interested in getting in, or potentially, if you're just looking for entry, a breakout. If you get back through 8.15, 8.20, and that volume's picking up and we close above it, then you could play the breakout as well.
All righty. Let's go to Freeport McMoran FCX.
Okay, maybe this is a really long, drawn-out inverse head and shoulder pattern. This stock is, I still think it's in a pretty good bullish pattern here. But what I would be watching is this neckline, potentially a neckline. Here's your move up. Here's your left shoulder, neckline, a little bit lower low, puts in the head, come all the way back up, neckline. Maybe the rising 20-day moving average could be your inverse right shoulder. And you also have gap support that comes in at about 1830 or so. So I think overall the pattern here looks pretty good. I'd really like to see this break out above $20. I think that would really get the buyers back in and behind FCX.
Okay, and the last one I have for you is Weight Watchers, WTW. I'd figure going into swimsuit season, they would be looking pretty good.
Yeah, it'd be interesting to look at the seasonal pattern. The stock has, obviously been in this uptrend for the last 2 or 3 weeks, but I do think it's established its high and low for consolidation. You can see multiple tops up between about 75 and 77.5 in here. And then the reaction low off of that back at 57.50. And that's a pretty wide range. But what I would be, when you think about buying, you have to think, okay, I'm not going to get in at 71 and set my stop at 57.5. There's just no way I would give a stock that much room. So you got to figure out if you're going to get in, where would you get in? And, maybe this breakout area right at around 67.5. If you get a little bit of a pullback, maybe you could use that as entry with a closing stop below the 20-day moving average. That would be something to consider with a target up at that 76 area, 75, 76, 77. But every time I look at a stock, I've got to be able to figure out how I can set my trade up so that I can get that 2-to-1, 3-to-1, 4-to-1 or more reward to risk. Otherwise, I don't want to take the trade. Even if I like the stock, I don't want to take the trade if I can't manage my risk.
Yep. Gotcha. That is 10 in 10.
All right. I tried to pick it up because I know you got your DP.
Yes, I appreciate that. I'm going to go very quickly on the rest of the parts of the show, and so I can get to my decision point report. But yeah, the symbols are there, and I'm going to go ahead and get us right into, actually, we're going to talk a little bit about ChartCon because we always do. And I want to get us to the right page for that. If you go to stockcharts.com/ChartCon, it will bring you to this page right here, so you can learn all about what we're doing in August. It's an online conference. We're concentrating on reducing risk. The agenda is below, as well as information on each of the speakers. I believe, yes, there you go. So you can see all the different speakers that are going to be there. 2 days online. You get to keep all of the programming from that weekend forever on your computer, so you can always go back and look at it. And if you want a sample of what we do, you'll see on Stock Charts TV, we do replay some of them from 2016. Can't guarantee you're going to see any of these on Stock Charts TV in the future, but you'll want to go ahead and get in on this now so you don't have to wait for 2 years or whatever it is when we finally do possibly replay these.
Yeah, and I was talking earlier, Aaron, when having John Hopkins on, showing how, we kind of evaluate risk, but there's a lot of different ways to evaluate risk. And you can go up to, I think it was Dr. Alexander Elder.
Yeah.
In his presentation, he's written books, and he's talks about how you can use market volatility for placing stops and reducing risk. I mean, that's literally what everyone's going to be talking about, is how each one of us manages risk. And that, if you're going to be in the stock market going forward, consider this an investment for many years to come. This isn't just a one day, I need to go buy Apple. This is about educating yourself on managing risk, making you a better trader or investor for many years to come.
Yes. So highly recommend, go check it out. And now I will go into our final market update. Alrighty, here we go. Let me fix this because I don't think I have the right ones in here, and I want to make sure I have there we are. So I added the TSX and I added TLT today, just because I got a signal on that, and I'll talk to you about that shortly. So as we could see, the markets are really right now unchanged. We've had some choppy trading. I mean, when you look at the Dow, we've been, just chopping around at this point. I'm seeing a triangle that's forming here, and that's a continuation pattern, and that would imply that we might get some more downside here. And you can see also the NASDAQ that it's now dipped into negative territory, and the Russell 2000 pretty much just before lunch pretty much lost its lunch. It's all the way down. It's moved down very quickly And currently Russell 2000 is at 1560.86. TSX, great day, really moving higher the entire day. We're pulling back just a little bit, possibly with our markets. You can see Treasury yields are rising, currently reading 2.98. We have UUP gapped up and continuing higher, so not a surprise to see that gap down on gold, and it is now consolidating at about 125.45. USO gap down, but managed to spend the entire rest of the day moving higher and higher till it got to positive territory. Right now, it's just sitting on its previous close. It's up 2 cents, 13.77. And as you can see, the VIX is lower on the day, which I find interesting. I'll have to see what that looks like on my chart. And we have TLT, which started lower, but has managed to get itself back up. Not quite to positive territory, but down only 5 cents right now, 118.41 for TLT. And with that, I'm going to move into the DecisionPoint report. Was there anything you wanted to add, Tom, before I go and do that?
No, I think we've pretty much covered it. I am a little surprised, and I'm sure that's why the question came up about the Russell 2000 earlier, the fact that it has fallen so much. But that happens from time to time. I wouldn't read too much into a half hour or a couple hours worth of trading.
Yeah, absolutely. We'll have to see whether the rest follow suit. All right, so I'm going to just go ahead and take us over to my DecisionPoint live chart list. You can get to all of these charts on through the DecisionPoint live chart list. Simply go to the blog articles and find DecisionPoint, and there's the live chart list. And it's basically, it has all of the charts I'm getting ready to show you. So if you want to go back and look at them, or if you want to go back and grab one and save it to your chart list, that's exactly where you will do it. Highly recommend you check out Carl's DecisionPoint weekly wrap that he wrote on Friday. It got stepped on by a lot of chart watchers articles, so you'll want to go in and find that. He gave us a really good wrap up. Technology, that was one of the things I noted as well. We got the buy signal, I wrote about it, and then the next day it switched to a neutral. So I was very surprised we got that whipsaw, but you know, with the down day like we saw in tech, it's not surprising. So let me go back. I'm going to take us back to the DecisionPoint live chart list. I'm going to start with the S&P 500 just to give you, what I want to do is give you the DecisionPoint outlook as far as price and trend, as well as market condition. And then I'll give you what I'm looking at for the big four, dollar, gold, oil, and bonds. And then of course, I'll be looking at my indicators. And again, that will tell us what the condition of the market looks like right now. And I will tell you that Carl is in the bear market camp. We do have a poll out there if you think we've entered a bear market at this point. Carl believes that. He's looking for confirmation with a 50 200-day EMA negative crossover. And of course, that, I think by the time we can get something like that, it'll be obvious to everybody that we are pretty much sitting in a bull market configuration. I'm not, I don't subscribe to that completely. I think we are looking at a very volatile market. I think that short term, it's not looking good, but I'm not going to sign up for the bear market, that we're in a bear market right now. I don't have the, I'm not seeing it in the indicators of price action, but I will defer to Carl a lot because he certainly has far more experience and has seen bear markets, whereas I haven't seen anything too bad, except, you know, really the 08 market crash was not good. But anyway, so I'm seeing as far as the S&P, we're at a point, we keep coming to these points where we have to make a decision. It needs to do what it needs to do. And right now we need to see this support level held. If we drop below this rising bottoms trend line, I'm not going to get overly worried. If we drop below 2650, I'm going to get worried. We'll have at that point penetrated and closed below the 20-day EMA, and we would be at that point testing 200-day EMA support. I'm expecting it to move further down, but I don't think we're going to see it go all the way down to that 200-day EMA. I reserve the right to change my opinion on that when and if my indicators change. So that is the S&P. I'm going to give you just a quick look at the NASDAQ and the Dow, and then we'll move on. So as you can see, NASDAQ 100, we're looking at the same sort of setup with, of course, most of the large cap indexes. They all travel very similarly. And we can see, again, we're at very, very important short-term support for the NASDAQ, just like we are as far as the S&P. And this is the time, if we're gonna avoid a short-term correction, we need to see the market turn up at this point in time. I've got the PMO buy signal. It is intact, but as you can see, momentum is starting to shift to the negative direction. And at this point, the OBV is still trending higher when I look here in the thumbnail. However, if I were to draw a rising bottoms trend line there, we would have broken that on the OBV. So we're seeing a lot of weakness out there, and I don't think it's gone. I think we still have some short-term difficulty ahead. As you can see, the OEX S&P 100, it's already broken down below that area of support that we've seen on those other charts for the S&P and the NASDAQ. The PMO is also turning down, and look at the OBV, it's really shot lower at this point. So the markets in the short term are not looking the way I would want them to look at this point. I would expect price trend to continue lower. Here is the Dow, and we can see that it's holding on to this declining tops line support area. And it also, I don't have it drawn in here, but it's also holding that support level at the top that we got for this rounded bottom. So that's still holding. Again, this is the place over this next week is going to be very interesting, because this is where the market needs to make a decision. It's at a decision point, and it needs to turn up right here. If it does not turn up, then I would expect more downside. When we look at the S&P 400, the IJH ETF, again, all of these look very similar, topping PMOs, looking at OBVs that are trending higher but trying to break below rising bottoms trend lines. So all of these are settled in that space that we need to see the turnaround, and it needs to happen now. IJR is interesting, the small cap ETF, because I see more room for pullback, and I suspect we're going to see more pullback on the small caps, and very interesting that we're seeing that turnaround today. Not so much on IJR. IWM, the Russell 2000, we're testing that support level like we were seeing on the large cap indexes. So again, very important area of support. We're seeing PMOs starting to top, telling us there's momentum problems at this point. So price, I'm really worried when I look at these charts in the short term. Let's look at the ultra short and short term and intermediate term indicators to give us an idea of what's going on with market condition right now. What I look for on my climactic indicator charts, these are breadth readings, as you can see, and then I use the VIX on an inverted scale, because I use the VIX in a very short-term time frame. And I find that when you get the penetrations of the Bollinger Band to the upside, meaning you get very low VIX readings, that usually is a tipping point in the short term to see a move lower. It works like sentiment. If everybody's very bullish and feeling very comfortable, that's where you're going to see a reversal. But I don't see, when I see a low VIX, I'm not looking for a long-term decline off of that. I'm just looking for the short-term, I call them pops that come after. Usually you'll see like a rally pop after a very high VIX reading when you get these penetrations to the bottom side on these. You can see that came in on that big black bar, and we did get a move upward the next day. It's similar. Here we had the penetration of that upper Bollinger Band, and it coincided with very climactic readings as far as breadth, and that pretty much fulfilled that downside move after getting that penetration of the upper Bollinger Band. So we've had that penetration, so we've had the decline off of that. Now I'm going to be watching it closely to see if we're going to get it to continue lower, where people are going to start getting more worried, which in the short term I think will be eventually good. We can see as far as readings from Friday, we did get some significantly, I'd say these are climactic readings at this point on the breadth, but I didn't see really a matching move on the VIX as far as penetrations are considered. So, you know, we have very negative breadth here, a pop, and generally I look at the breadth and the VIX. When I get these climactic readings, I'm trying to determine, is it telling me that there is an exhaustion of this very short-term trend, or is this an initiation? And I determine that based on what the previous couple of days of trading have brought. So in this case, we have these climactic readings to the negative side. The VIX isn't all that helpful, so I'm not really paying too close attention to it at this point. So I'm looking at highly negative climactic readings. So is this a initiation to the downside, or is this an exhaustion of the selling? And when I look at the previous move, it was a decline. So I would be looking at these as more of an exhaustion reading for short-term selling. So I would expect a little bit of upside. I would have expected to see the market up a little bit today. So far, that's working out. We'll have to see what happens by the end of the day. Short-term indicators have been the problem. I've been writing about those in the DecisionPoint blog. We have topped and we are heading lower. But one of the things that one of the viewers who made a comment in the question box was that there is a negative divergence going on between the STOB and the STOV. This is volume based. So when I see volume tops starting to go lower, yet I see rising tops on the breadth indicator, the STOB, that is a signal that there's a problem. And you don't see it very often. You just don't. And in fact, I never used to really look for these that much because they never appeared. Usually you would see these travel together. I don't worry if I get a difference in the readings based on the STOB. For example, if I see that the STOB is rising and maybe and then we have this rising, I'm not really going to pay attention. There's no divergence there. But right now we're seeing a significant divergence. We didn't even get it as significantly as last time. You can see it did precede some downside action. Over here, we also had a negative divergence, and it came in and we did see some downside action. Obviously, this was very painful. I'm very concerned when I look at this and see these negative divergences like that. That tells me that we're looking at a problem, not just in the shorter term. So this indicator chart tells me to expect more downside in the short term. Intermediate term, I've felt pretty good about. I still feel fairly good about. We are seeing them top right now, but they're still above this declining tops that I had drawn in last week. And we don't see a negative crossover yet. I don't usually get overly concerned until I see those crossovers on these indicators, and we're not there yet, but it isn't good to see them turn down at this point. So I would look at these as rather neutral. They're sitting in neutral territory near the zero line, and they are topping, but they are topping after a breakout from declining tops. So I'm looking at them as mostly neutral right now. So let's get really quickly into the dollar, gold, dollar. Yay, we finally got the breakout we've been waiting for. Very happy, but I want it to be decisive. And that means it needs to be about a 2 or 3% breakout before I'm going to believe it. But at this point, I think we're on the right track. I think we've finally seen that breakout. The buy signal has now come in. And look at the OBV starting to turn up, and that scooter looking really good. So I'm expecting the dollar to move higher. I'm bullish on the dollar. As far as gold, I am now bearish, more so. And we have a PMO top. Look at the scooter for GLD just falling out of the sky. And we've tested the top side here of this overhead resistance. We've tested that and we're heading back down. I'm looking for a test down here at 1310, 1305 for gold, USO. USO looking fantastic. We're getting these gaps. This was a nice breakaway gap. This was a continuation gap here. We haven't closed it yet. I don't expect it to. And if it does, I think we're going to still see some more upside. The PMO looks fantastic. OBV is continuing its trend higher after breaking above that declining tops trend line. We have a scooter that's staying in the hot zone. And then look at WTIC. It also was looking at this ascending triangle, which is bullish. We got the breakout. I'm looking for it to hold here at that area of support, which was previous resistance. So USO is looking pretty good to me at this point. And when you look at the weekly chart, I'll just give you a peek at that. You're seeing a nice breakout here on the weekly chart for USO. We've got that breakout again above 12. We've held it. And look, we've got a lot of upside potential here. The $14 range sort of lines up right here for that support level that we saw back here in 2015. But I'm expecting a move up to $16 at this point, and that PMO is starting to look healthy again. Finally, on bonds, I am bearish on bonds. And you can see why. We had a continuation, a symmetrical triangle. It dropped out of that. It did not fulfill the pattern, which is a continuation pattern. We should have been seeing higher prices. I had already seen the PMO topping before we got the gap down, and things have just gotten more ugly since then. I would look for bonds to continue lower and certainly test this area of support here at about 116 for TLT. And with that, I'm going to conclude my DP report. I'll show you the summary slides of what we've looked at. So as far as stock market condition, my climactic indicators, they're mostly neutral, but remember, I did just get that exhaustion reading. But I think that was fulfilled really today. It's going to be fulfilled because if we close on the upside, I'd look for that. Short-term indicators are falling. They're overbought. We have that negative divergence. I would say they're bearish at this point. Intermediate term indicators, while they've topped, they're sitting in neutral territory. I'd say they're somewhat bearish, but I'd even look at them as more neutral. And then as far as our stock market trend price action, I think price action right now is bearish. We need to get that move off of support. We're not seeing it. Intermediate term is mostly neutral. Weekly charts look pretty good. Long term, I am still bullish because if you look at the DP scoreboards, they are all green in the long term. As far as the big four, waiting a decisive breakout. So I'm bullish right now. I'd say more bullish than neutral to bullish because we did get a breakout today on a gap. But I would like to see a decisive breakout, and that would mean a 2 to 3% breakout. Gold is reaching that resistance. I'm bearish. Oil, the gap closed, strong support, bullish. Bonds, we just got a new intermediate term trend model sell signal, and that is bearish. So that concludes the Decision Point report and pretty much the show.
It does. I guess we will go quickly into the schedule and wrap things up.
Yes. So weekly schedule, Wednesday, a day after tomorrow, we have Gaddis Rose. I'm going to be doing my workshop on Thursday on moving averages. And Friday, we will have everything stock charts. And we'll see what they have in store for us. With that,
another solid week ahead for sure. Looking forward to it. We do want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's at the lower part of your screen. Just click on it. Very brief survey. We'd love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everybody, and we'll see you back here on Tuesday. Happy trading.